Today, investing in brownfield, in renewables, it becomes more and more challenging. The returns have been compressing a lot. So the newcomers to the market intend to tackle the market doing new construction, doing their own development, and therefore increasing in that respect, on one hand, the returns, and then on the other, ensuring that the quality of the build is made according to their standards. Where those new players don't have the capacity in-house to take care of that element of the value chain, they have deep pockets, so they can easily acquire construction companies that can do that job for them, and therefore create a synergy within the group that probably the institutional investors will find more difficult in terms of financial investors.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm Barillas, Head of Iberia at Aurora. My guest on the show today is Federico Giannandrea. Federico is a partner and Head of Continental Europe for Foresight. For our listeners that might be less familiar with Foresight, Foresight is an infrastructure and private equity manager with around 7.2 billion of assets under management and close to 30,000 private investors, including financial institutions, government organizations, pension funds, and insurance companies. Federico joined Foresight in 2010 and now travels between London, Rome, Madrid, and Luxembourg in his role as lead of Foresight's infrastructure investments across Europe. Federico, thanks for joining me.
Anna, thank you very much.
Before we get into the content, I wanted to pick up on an interesting point from your CV. You actually started your career as an M&A lawyer at Allen & Overy. So tell me, what was the draw of banking and ultimately infrastructure investment from your start as a lawyer?
It's a good question, Anna. Thank you. I started as a lawyer because I really liked doing M&A. And while doing that, I thought that the role for me was a little bit reductive. And I wanted to do something a little bit more engaging. And when I saw that clearly you were working for a principal that was conducting the negotiations, I really liked the idea of being that part of the table instead of just being an advisor. What happened was that in 2005, actually, I had the opportunity to go for a secondment at Deutsche Bank in the legal department. And then there, in those years, there was the boom of renewable infrastructure. So while I was sitting in the legal department, there was an opportunity actually to start working with the global principal finance desk that was invested in renewables. And after a while of cooperation with them, in which I was in charge of doing the structuring for that desk, I was actually asked whether I wanted to move across and help them create the, let's say, renewable energy portfolio for Deutsche Bank. And then I haven't stopped ever since. So that was my kind of transition into the principal investing and infrastructure, and in particular renewables.
Brilliant. So you were pulled over to the dark side, as you say.
I was pulled over to the dark side. That was a definition that was given in banking when some lawyers were transitioning into the business parts. Yeah.
Brilliant. Right. So let's get into some of the topics I wanted to cover. And, obviously you have a very broad perspective on some of these issues. So it's great to have you join me and talk about some of these things. The first thing I wanted to talk about is kind of the changing value chains in renewables. So in your role, as I said, you have the benefit of observing renewable investments across jurisdictions as well as different parts of the value chain. Have you seen significant changes in renewable investment across Europe? More specifically, I guess, do you see value shifting across development stages as investment in renewables accelerates?
Indeed, I do, in the sense that the market is changing continuously. And I think in the last 2 years, even during the pandemic, we have seen that it got a lot more attention than before, even from investors that up to 2 to 3 years ago were not even looking at renewables. So the fact that now utilities and oil companies have joined the table, obviously having deep pockets and wanting to invest in the sector, because obviously they need to have their own ESG policy and targets, as creating an incredible competition in the market, which obviously as an effect translates into, let's say, yield compression. Now, given that, clearly many investors are actually moving the time of their investments. Institutional investors in general back 5 to 6 years ago were only buying assets at commercial operation date, and therefore not investing neither in construction nor in development. And so construction and development had a higher value in terms of, let's say, basis points that they have today. So the yield compressed across the whole value chain. So we're seeing many investors entering early the market, taking development risk, taking construction risk. And while we were seeing back in the day about 250 basis points between investing in development on one hand and then doing the construction, today, doing that actually has a lower value. And we've seen the numbers between 1% to even 0.5%, so 50 to 100 bips. This is not a negative thing in principle, but obviously requires that all these new investors have some new skills in order for them to be capable of managing those parts of the value chain, because obviously the know-how was only on the managing of the plant or optimization of the plant from a financial standpoint or from a technical standpoint. And now they need to look at how the plant is being licensed. What are the challenges in managing the construction? How many people you need to have on the ground to make sure that the construction is done according to plan, within budget, and delivering the results that you want to have. So that's, I think, the biggest shift that we are seeing. And especially those industrial investors, so the utilities and the oil companies, can manage those risks better than probably some of the financial investors, because they've been doing that for years in different other sectors. And therefore they have the skills, the quality, the personnel, and the capabilities in terms of organization to do that.
Brilliant. And I guess, you know, an outcome, I guess, from this is also that there might be more vertical integration, I guess, in terms of development and construction. So you have this kind of entities that are doing more. And so, you know, the market, I guess, you know, benefits those larger companies that are integrated across the whole value chain. Is that true? Is that consistent with what you're saying?
Yeah, I think so. There are two different, in my opinion, vertical integrations, in the sense that you have the typical contractors that have been building solar plants, wind farms, that over the years have started investing massively into development in order for them to be capable of delivering, let's say, a turnkey kind of product to the financial investor. And that vertical integration has already happened. And if any, it's continue developing, because they need their own captive pipeline, because otherwise only offering the EPC service is kind of a commodity today. And therefore, that's not where they have the added value. In terms of the, let's say, industrial investors, so the utilities and the oil companies, they're trying to do that. They're trying to do their own development in-house. They're trying to reach agreements with developers. Depending on the type of industrial investor, they might be capable of managing the construction themselves or not, depending on the asset class and depending on the, clearly, on the experience that they have in the specific sector. But clearly, this is going, this is developing even more. So if you take a pure utility, maybe they use an external contractor. If you look at like an oil company, I don't know, the Eni or whomever, across Europe, they have their own construction company within the group, and therefore they use their own company. That allows them to have control over the construction, application of their own standards, compliance with all their policies, and clearly extract more value than a conventional institutional investors can do, or a financial investor. And we see now today that actually those companies, so those industrial investors, are now looking for partnership with financial investors in order for them to have the know-how of the financial part and combine the two things together. So that's the kind of new wave that we are seeing. Many deals have been announced of partnership in this sector in Italy and Spain. And I think it's going to keep on growing, because that's going to be the future.
And in terms of how, so we've talked generally, I guess, and I'm sure this applies across technologies, but do you see it differently across different types of technologies, say wind and solar? Is it, you know, presumably there are some technologies that are more just the sheer complexity of the development process and the investment lends itself more to vertical integration than others. Is that true, do you think?
Well, I think it's simpler to do some vertical integration in wind and solar, because obviously the technologies are simple, they're proven, and if you put them on a scale, probably solar is the simplest, followed by wind, and then you go into more complexity of, I don't know, the bioenergy sector. So you have biomass plant, aerobic digestion, waste to energy plants, hydropower plants. So if you put them on a scale, probably solar and wind are the simplest. So vertical integration in these two sectors is easier than in others.
Makes sense.
And companies of big size have the opportunity also to do some acquisitions. So if they don't have their own construction company within the group, over time, they can do a selective acquisition and acquire that kind of know-how. So there is a difference, and you're seeing instead on the more complex kind of set of renewables that generally those are done by specialist contractors. So it's more difficult that you have in-house contractors for those big corporations that can do the construction, because you have different components and different providers of technology. But over time, probably, if the yield compression continues, we're going to see once again, specialist companies being acquired by these large groups in order for them to have the full picture and the full, let's say, capabilities to do anything they want.
So that's really interesting. I mean, we've seen the acceleration, I guess, in the vertical integration across the whole value chain happen for a while, but it certainly seems to have accelerated over the last kind of couple of years as the investor pool becomes a bit more varied and you have more investors pile into the renewable, idea and investment proposition.
The vertical integration is playing is going to play a big role, considering the fact that, as I was saying, today investing in brownfield in renewables it becomes more and more challenging. The returns have been compressing a lot, so the newcomers to the market intend to tackle the market doing new construction, doing their own development, and therefore increasing in that respect on one hand the returns, and then on the other ensuring that the quality of the build it's made according to their standards. Where those new players don't have the capacity in-house to take care of that element of the value chain, they have deep pockets, so they can easily acquire construction companies that can do that job for them, and therefore, create a synergy within the group that probably the institutional investors will find more difficult in terms of financial investors. And that's the reason why, as I was saying before, we're seeing more and more partnership between financial investors and industrial investors in order to join the two elements of this market, where you have an industrial component and a financial component, but the market transitioning from being a subsidized market to an unsubsidized market clearly is industrializing over time, because dealing with merchant risk is something that those kind of players have been doing for years. And they have the financial capability and the let's say the capital, human capital know-how to do that, while the financial investors will find it a little bit more difficult, but not impossible to do, in the sense that I'm seeing over time that financial investors like us get more engaged in the trading of the commodity of the electricity. And I wouldn't be surprised if in 2-3 years, many of those will actually have like a desk that trades electricity within the corporation itself. So it's challenging times, but it's interesting. And the renewable energy market is an ever-changing market. I started in 2007, Absolutely. And I've never seen a market changing so much over time. So we're going to have new challenges, but that's the beauty of operating in this field.
Absolutely. This is actually a good segue into the next kind of set of questions that I was hoping we could cover around bottlenecks. So we've mentioned it before in just now. So to reach renewable targets across Europe, we need a level of annual investment and capacity growth that we just haven't seen before. That is of course on top of the growing renewable ambitions in the US and the rest of the developing world. Do you think global supply chains are ready for this acceleration in demand?
It might be a bottleneck, but if there is one, I think that the relevant companies that produce this equipment will actually get equipped in a way as to face the new demand, and therefore building new plants that can deliver the supply that is requested. How this is going to affect the prices, it needs to be seen. Clearly, there's here a difference between the solar and wind, for example. So while the majority of the solar components are produced in China, on the wind side, we have a lot of contractors that actually produce either in Europe or in the US. And China is actually, let's say, a little bit behind in that respect. We have wind turbine manufacturers in China and India, but it's not as developed as obviously it's in the West. Now, how this is going to affect the price, I don't know. And then the, let's say, trade war that started a little bit with China, I think is going to play a role in terms of the bottleneck, if they can then decide who to supply and who not, and at what price. That clearly will be one of the bottlenecks, but it needs to be seen how this develops.
So what do you think are the major bottlenecks for renewable development in Europe then, Federico?
Well, let's start with the first one is the licensing. So there's a lot of demand for new capacity to come online, and there are numerous applications that are made to the relevant competent authorities locally to build new plants. And it is difficult for those local authorities to cope with the volume of requests that they have. And you pair that with the fact that even the relevant network operators have the same problem, because the capacity that is coming online not always can be managed by the existing network, and therefore they don't give, in many cases, let's say, possibility of connecting to the grid. Those are the two initial bottlenecks that we're going to see. The third bottleneck is the fact, how long then does it take to get the license? So assuming the first two are okay and the offices work properly, what are the challenges across the licensing process, and how much the environmental impact is going to play a role in this new, let's say, capacity? Because obviously, the most you put online, the most is the environmental impact. And people are talking already about the fact that they don't know how you're going to dismantle and dismiss and recycle all the components of the various plants over time. And therefore, those are going to be part of the new bottlenecks. Then the third one is finding the right capital at the right price, and the timing to do that, and therefore how much capacity can we bring online per annum on the basis of the players that we have today, and how can we cope with that kind of growth? Can we reach those ambitious targets? It's still a question mark, because obviously at those lower returns that we are seeing, so with that yield compression, is that something that is still viable? That's a question mark. So when the price of the various components reduces over time, we have seen over the years that the returns on the investor were more or less stable at a certain level. Now that is not longer true, so those returns are reducing. We have to see whether there's going to be capital, a debt cost of capital, that we actually will allow the build of those plants. While before you were having the tariffs, and therefore you had almost certainty of your stream of revenues, now that you enter the merchant markets, is it that going to be viable? Is the price of electricity going to be capable of sustaining this type of growth? Do the countries need to reinsert new tariffs in order to support the growth of renewables? That's a question mark that has not been answered yet. And I think in 2-3 years, we're going to see how it's going to pan out. It is true that there's a new wave of unsubsidized renewables, both in solar and wind. Solar, especially in Spain, the wind much more in the Nordics. Other countries are lagging a little bit behind in this respect. And today, the price of electricity technically sustains these unsubsidized, although investors still want long-term contracts in order to be able to invest in the sector. If the price of electricity, as somebody forecasts, will go down over time, will that price still sustain the same growth of renewables? That's really difficult to forecast. I suppose it is, and I'm a believer, and we at Foresight are believers of the fact that obviously renewables will keep on playing a pivotal role in the years to come. But what will be the level of returns and what will be the investors of tomorrow still need to be seen.
No, that's absolutely that's critical in terms of kind of thinking about the transition. And you mentioned this interplay between kind of regulated or some sort of revenue streams that are predictable, so CFDs or the like. So even if they're not necessarily a subsidy as such, they're a certainty in the revenues versus the merchant kind of business model. And obviously, what's fascinating about all of this is that for those merchant players, the ones that are going ahead and have the stomach to invest in merchant assets, one of the biggest risks is that the government starts intervening with more kind of regulated tariffs, because at that moment you break the link between kind of a market that's correcting itself endogenously, where, you know, if the market prices are too low to sustain renewables, and you would expect people to stop investing, and then, you know, nobody gets too hurt. Obviously, if the government start intervening and saying, no, we need more renewables, despite how the market prices look, then that's a big risk for merchant investors. So that conundrum, I guess, of kind of the risk of government intervention actually hurts some of the merchant kind of business model is an interesting one.
It's going to be an interesting dynamic, and it will be driven by the price of electricity, as we all know. If that falls below a certain threshold, then the plants are not viable, and then you need those CFDs or auctions or whatever you want to call systems, which are already available in different countries across Europe. But the relevant auctions basically assign lesser capacity than what is available, because still the merchant allows to get better returns than the ones with the CFDs. If that trend inverts, and we're going to see then new plants that would benefit from tariff, and therefore we will have much more institutional investors and financial investors than, let's say, merchant investors, meaning those like the utilities and the oil companies that actually can have different synergies compared to financial investors in the sector.
Absolutely. So you mentioned it, so that the three bottlenecks that you mentioned, that the first two kind of were licensing and grid. What can investors do to mitigate this risk? I mean, they seem like risks that are largely outside your area of control as an investor. What does Foresight do about this?
Well, it is not technically outside your possibility, in the sense that you, as an investor, try to find reputable developers and do agreements with them in order for you to secure your captive pipeline. So you mitigate your risk, investing a little bit early. Now, while about 3, 4, 5 years ago, none of the funds that were launched in the renewable energy had actually pots for development. Many of those that have been launched today have that kind of possibility of investing, and therefore by securing your pipeline, you're actually reducing that kind of risk. Obviously, what you can do with that development is a function of the mortality rate of those projects. But at the same time, that mitigates your risk, because as soon as they're going to be licensed, you can build them and bring them online. In terms of the price of electricity, there's not much you can do other than clearly at the time in which you make the investment, either hedge your position, entering into a long-term contract for the price of electricity, but both those contracts are no longer than 10 to 15-year maximum. Here in Europe, differently, for example, from the US, in which they had PPAs lasting for about 25 years.
Yeah.
But this is where the new dichotomy or let's say the conundrum is the fact that how much are you leaving on the table at the time in which you actually buy your hedge? Because we've seen that spot prices of electricity in Southern Europe are now far above 60 euros per megawatt hour, with peaks at 75 in Italy. While if you're looking, for example, at a long-term PPA in the Spanish market, you are well below 40, if not close to 30 euros per megawatt hour. So you're leaving on the table about half of the value at this point in time. Now, the additional conundrum is, how do you convince institutional investors to take merchant risk and therefore not to buy the PPA, but running the plant on the basis of whatever the price of electricity is going to be? This is the challenge that we as fund managers are confronted with in trying to convince and educate those investors to actually make that kind of move, which they have been doing in the years, because banks and other financial institutions have been financing utilities and others that actually take that kind of risk. So the risk is known. It's just that the application to the renewables is not as developed as it is in other sectors. So we're going to see how the market is going to shape and change in the next 2 to 3 years to face this new challenge.
Brilliant. One of the things that I think is emerging as a key concern for renewable development is the interlink it has with kind of mining and the requirement for key materials. So the renewable growth really that underpins the energy transition requires millions of tons of raw materials to be mined, is the point. Batteries depend on cobalt and lithium and nickel. Rare earth minerals and elements are used to make the magnets for electric generators and motors. And of course, you have copper, which is required across the whole kind of renewable energy system for things like inverters, cables, etc. The IEA has actually recently released a very interesting report on this, on the interplay between kind of mining and the renewable sector. So the first question on this, I guess, is, do you think the mining of minerals like cobalt, lithium, nickel, and copper will become an important bottleneck in the growth of renewables?
It could become a bottleneck, for sure. Clearly, the mining of the raw materials, it's key and pivotal for the creation of the relevant equipment. And if we look at how, let's say, the resources are owned or mined, we would see predominance of certain countries over others. And therefore, for example, China is one of the largest miner across the world, especially in Africa and South America. And therefore, there's going to be some monopoly in that respect that everybody fears at the moment. How this is going to affect the prices of the components, and how can we make sure that, considering the fact that we need this type of mining to create renewable energy, how this, let's say, is inserted in the total value of the ESG credentials of what we do is going to be the challenging of tomorrow. This is what I think can be called the paradox of ESG, because there's always somewhere in which you can't be perfectly, let's say, environmentally friendly or perfectly socially responsible or perfectly having the right governance, because there are things that have their own limits that you can't change. So you can do the things better and limit to what can be the negative aspects of whatever you do, but you can't eradicate totally the elements that cannot be eradicated. And therefore, this is going to be the challenge, in how investors and all those that actually look at your ESG credentials and do the tick boxing exercise are going to value this. You could also see that maybe we stop producing certain type of equipment, because of the fact that mining that is underlying that kind of equipment is not sustainable. So the sustainability of the whole, let's say, supply chain and value chain of producing the equipment is still need to be assessed in full. But we've seen a lot of efforts by many of the players to try to, let's say, analyze it down and trying to minimize the negative impacts of whatever is done across the value chain.
That's fascinating. And as you said before, that the ESG element of this is one of the key concerns, right? Because, obviously one way of addressing bottlenecks is to increase investment in it. And clearly the demand is there. But the mining sector often puts off investors because the ESG credentials are not traditionally the great. So that is certainly one of the elements that, would need to be sorted out. Just to kind of build on that, then, do you think a company like Foresight would consider investments in the mining sector to mitigate some of this potential risk over time? Or is that something that is just completely outside kind of what you consider your realm of investment opportunities?
I honestly don't know how to answer the question, in the sense that we will see when the time comes whether it makes sense to do that type of investment or not. And if we will deem that that's something that we need to do, we're going to have to raise the relevant funds to do that. At the moment, at Foresight, we don't have any funds that can do mining. So going forward, and depending on how the ESG credentials will be assessed in the various mining sector, there might be a possibility of us investing there if that becomes key for the growth of whatever market we're going to be. So it needs to be seen. But it might also happen that we will do the investment, or we won't do them because those are not, let's say, compliant with our spirit, because ESG for Foresight is kind of a mission rather than being a tick box compliant exercise. We prize ourselves to be a sustainable asset manager, and sustainability is something a little bit above ESG. So we think that more and more effort shall be put into analyzing and making sure that whatever we do is done properly and is done with less impact to the whole environment, and is sustainable over time. And therefore, it's going to be an interesting development that all the players of these markets will be seeing in the years to come.
Absolutely. Brilliant. So just one last, and I know we're kind of running out of time a little bit, but one last kind of area I wanted to explore with you is that of kind of local partnerships. And we've already touched a little bit on this in that first question. But just to build on the experience that you have at Foresight of investing across kind of Europe. So your footprint covers a lot of countries across Europe, and I wanted to touch a little bit on the logistics of what it takes to make that happen. So as an investor, is it difficult to enter a new market in Europe? And what are the key things that you have to put in place to make that a success?
Penetrating a new market, it's never easy, and clearly there are a few things you need to take into consideration. First of all, you enter the new market generally buying a new asset. So you need to make sure that the asset you're buying, it's actually proper and fit and complies with whatever you do elsewhere. And then in order to do that, you need some local content. So you need to have somebody on the ground that speaks the local language that can actually ensure you that what you're doing is actually done properly, because every country operates differently. And despite the fact that the solar plant or the wind farm are actually the same in terms of technology anywhere, the way they are installed, the challenges and the local regulation differ from country to country. We're strong believers at Foresight that local presence is key in order for you to acquire, build, and operate those plants effectively. And this is the reason why we have local offices. We have Italy, we have Spain, we have Luxembourg, but it's much more for regulatory purposes. But we also have people on the ground in the other countries in which the assets are. So we have people, for example, in the Nordics, we have people in Germany where our assets are located. In terms of entering the country, it might be useful to find a local partner. So you can enter into joint ventures in that respect. You might have local asset managers or local developers or local companies that actually operate in that field. And that simplifies your entrance in the country. But once you've entered, we, for example, tend to insource then over time the various functions, because we see that having a hands-on approach on our asset management, on our assets, is actually more efficient than actually delegating it to a third-party provider, because even if you delegate, you need somebody that reviews what your contractor is doing over time, and they don't take decisions on your behalf. So we've seen that by doing the hands-on asset management, we reduce the speed of our interventions. We're much more efficient in terms of timing, in terms of money spent. We control better the value of the plant, and we can ensure also a better output from the plant themselves. So it's a combination of elements. But for sure, local presence, it's key if you want to enter a country and to permanently, let's say, grow your business in there. You can't do it remotely.
I know. I'm sure that's the case. I mean, and it's not only differences between countries. Obviously, it's even differences between regions within a country, and how different autonomous communities, for example, deal with the permitting, environmental permits, etc. So yeah, no, it gets very complicated very quickly if you don't have that degree of local knowledge, I'm sure.
One of the risks locally is to get lost in translation. And this is a function of the fact that people believe there are business rules that are commonly accepted, but in reality, there are different business rules that change from country to country. So having a local person will guide you through those peculiarities of the relevant country and solving the local problems according to what is the local standard way of solving those. I'll give an example. If you have a problem here in the UK, it's very common to send an email and maybe set up a call, and then the politeness of the email generally brings you to the solution of the problem. If the problem can be solved, it's solved. If it cannot be solved, it's not solved. In other jurisdictions, maybe people just receiving emails find it offensive. They want to be called. They want to see you in person. They want you to go and go to the plant because they want to show you what's going wrong or what can be changed. And then they want to have lunch or dinner with you. And that's an important part of establishing the relationship. Every country is different in this respect. And we have seen over the years how that differs from Southern Europe, for example, to Germany, to the Nordics. Every country has its own peculiarities. Every country does it differently. And that's why the local knowledge is fundamental.
Yeah, the cultural differences between countries I find fascinating. Within Europe, you can do business very differently, as you were saying, and it's very easy, as you say, to fall through, and make easy mistakes to make just because you're not aware of the cultural differences. So that's a brilliant point. Thank you. Federico, I'm sure we could keep going for hours, but we should probably bring this to a close now. It was an absolute pleasure to chat with you today. Thank you so much for taking the time to speak with me and share your views with our listeners.
Anna, thank you very much for inviting me. It's been a pleasure to be with you today. Thanks a lot.
That was Ana Barillas, Head of Iberia at Aurora, speaking to Federico Giannandrea, Partner and Head of Continental Europe for Foresight. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening and goodbye.